What's up with an options grid? We're going to go over that today. And I know they can look a little scary at times, but we are going to break down the essentials that you need to know when looking at an options grid. Hey, I'm Luke Downey. Here's another edition of Lessons with Luke. I talk about stocks, options, sometimes real life. Just want to make you a better investor. So make sure to like and subscribe to our YouTube channel. So let's get into it. I've talked about buying calls. I've talked about selling puts on this YouTube channel. I've also talked about my favorite strategy, which is a bullish risk reversal. Now, I think to tie it all together, we should look at an options grid. Especially if you're new to options trading, you're going to want to know your way around the grid. So let me go ahead, share my screen, and let's get into it. So as an example, we're going to be using Ford. Okay, ticker is F. I've owned this thing for a number of years, excuse me. And the crazy thing is, it's at a 20-year high. I was looking at the chart today. I was like, oh my gosh. So anyway, that is going to be the example that we will be using today. First thing you want to know is whenever you're looking at an options grid, make sure you have the right ticker. Okay, so for Ford Motor Co., it is going to be ticker F, and you can see that right there. Also, you want to notice that Ford is trading at $19.30. So remember, options are tracking the underlier, and the underlier is going to be the stock. So now that we know that we're talking about Ford, it's about $19.30 at this time. Now let's start to work our way into the grid. I am using Fidelity because that is where I have some of my accounts. And it is really intuitive. And a lot of other brokerages will have an options grid that is very similar. So first thing you want to do is you want to figure out, are we talking about weekly options or are we talking about monthly options? Weekly options, they just expire on a given week on that Friday. So you can see here. So today in this example, it's November 4th. So there are options that expire weekly, literally tomorrow, November 5th, November 12th, November 19th. You'll see that November 19th, it doesn't have that W. That's because it's a monthly option. Okay. Monthly options expire on the third Friday of the month. Now, typically, I'm not doing a lot of weekly options whenever I'm looking at an options grid. I'm more interested in monthly. So let's turn off the weekly. And most of the grids that you're going to be using on a brokerage account, whether it's TD Ameritrade, probably Robinhood too, they're all going to be relatively similar to this. So I'm going to apply that just so we're only looking at monthly options. Now, in this example, it is November 4th, right? You can see that right here. Thank God for the old calendar. Now, if we look at November options, that's the monthly option. You can see that right here. It tells us that it expires in 15 days. Okay, so 15 days is roughly 2 weeks. Okay, it's not that long for an option. That's like a near dated option. But let's just use an example and try to figure out where Ford is relative to at the money. Okay, so at the money is going to be right near where the stock is trading. So we know the stock is between 19 and 1950. So in the middle of an options grid, get your notebook out, are the strikes. So these are all the strikes. They tend to go from lower to higher from, they start working their way down. That's just the way they do. On the left, you'll notice are calls. Calls. To the right are puts. Okay. Whatever grid you're using, most likely calls are going to be on the left, puts are going to be on the right. Now, there's also a bunch of other information, very similar, just like stocks. They'll have the last price that it traded at. They'll have the change on the day. They'll have the bid of the option, the ask of the option, the volume, open interest, implied volatility, delta, etc. You're going to have that for calls. You're going to have that for puts. Okay. We're not going to get too far into the weeds here. We just want to know the basics of how to read the grid. Now, because Ford is effectively in between 19 and 19.5, I want you to look over here at what a 2-week call option would look like. Okay, to buy the 19 strike call, you would pay the offer or the ask. Okay, the bid is 99 cents. The offer is at $1. So if you were going to be buying this option, you are going to be paying $1. Okay. Now remember, one contract represents 100 shares. So you would be spending $100. That's for the 19 strike call. The 19 and a half strike call, it'll only cost you 80 cents. So you'll notice as you get further away out of the money from the stock, the call options are going to be cheaper. Okay, so a 20 strike call is 63 cents, 20 and a half is 52 cents, etc. Let's go ahead and look at the puts. Same thing, all right? So a 19 strike put, work our way over here. We see that the bid is 72 cents. The offer is 74 cents. All right, so if you're a big bad bear, you think Ford's going lower, you want to buy a put, you're going to be paying the offer. That's 74 cents. Okay. Very tight options here. Now, if you want to take it down to 18, right? You don't want to spend that much premium. You want to protect your downside. Buy a put for 32 cents. You could buy the 18 strike put. All right. Now, as we go further and we look at December, which is a month away, 43 days, let's look at the 19 strike call. 19 strike call is more expensive, right? Because there's more time value in that option. You would have to pay $1.44 for one of those call options. For a put, the 19 strike put would cost you $1.19. That's if you were going to buy that put. And then we'll look at one other example. We go out to January. You're going to notice the same theme. The 19 strike call in January, it costs more, right? There's more time value, $1.79. The 19 strike put, right? Because you're a big bad bear, you'd have to pay $1.54 for the Jan 19 put. So that is the basics of the options grid. Okay, so literally in the middle, strikes. Okay, so that is going to be at expiration, something's going to happen based on that strike price. Okay, on the left are calls, on the right are puts. Now let's go ahead and do another example. So we're going to use Ford as our example again. And we're going to go through 3 of the trade types that I like to do. Okay, and keep in mind, they're all bullish trades. Okay, no big bad bears here. So we're also going to talk about January. I'm going to go out a couple of months. I'm just going to deselect these months, and we're going to be talking about the January contracts in Ford. Currently, it's $19.32, and also today is November 4th. So the first trade that I'm looking at in this hypothetical example is I'm looking to get long Ford. And so to do that, if I wanted to buy one of the Jan 20 calls in Ford, it would cost me $1.37. So let's think about that. You're going to buy one contract of Ford, one of these call contracts, $1.37. Remember, one contract represents 100 shares. So you got to multiply 1.37 times 100. That means this call is going to cost me $137. But at expiration, all the way through January, I have the right, if I own this call, to buy 100 shares of Ford, paying $20 per share. So that's one example. Let's just say that I am also bullish on Ford, but I'm looking to earn income. So how do you earn income with options? Well, you can sell a put. So I'd be looking at selling a downside put. And let's say I want to do this over the next couple of months. January, it's a 78-day option. Okay, so it expires January 21st, 2022. Let's just say I wanted to sell one of the 18 strike puts in January on Ford. I would be hitting the bid, right? Because whenever you sell on the bid, all right? And I would be collecting, in this example, 1.04. But remember, one put contract represents 100 shares. So I got to multiply the 1.04 times 100. So if I sold a put on Ford, this 18 strike put, I would be collecting $104. Okay. Now, when you sell a put, remember, there is an obligation to potentially have to buy 100 shares of Ford. Okay. So if at expiration, Ford is below 18, or if Ford is below 18 at any point up until now through January, there is the chance that you could be put the stock. Okay. You could end up buying the stock. Okay. Because whoever owns that put could exercise their right to sell shares. Okay. And if they exercise that put, you would then have to go buy 100 shares of Ford at 18. So just keep that in mind. Whenever you sell a put, there is that obligation, that potential obligation to own the share, the stock at that strike price. Okay. Bada bing, bada boom. Let's do our final trade example. We're going to be using January and we're going to be using Ford. Let's just tie this all together. And let's say we wanted to do a bullish risk reversal, right? So Ford, it's $19.32 right now. I am looking at selling one of the January 18 strike puts, collecting $1.04, using that premium to buy one of the January 21 strike calls. Okay. And I would pay right about 106. Now, typically when I'm doing these trades, I want to do them for either zero or a net credit. So I'd probably have to put a limit order on this so that I could try and sell that put for 105 and buy this call for 105. All right. I don't want to pay for this combination. But what would be my risk profile on this risk reversal? Okay. Remember, by selling this put, I have the obligation, the potential obligation to be buying shares of Ford at 18 now until expiration. Vice versa. Let's say Ford continues to rally, keeps going to the moon, whatever, right? Because I have this call, because I'm long the January 21 strike call, right, that I would hypothetically pay 105 for in the middle here, that gives me the right to buy 100 shares of Ford. Okay. So that's what we're looking at. So a risk reversal saying, hey, this bullish risk reversal saying, hey, Ford is $19.32. I am willing to buy shares at $18 by selling this put between now and January. And also, if it doesn't get down there, I am also wanting to participate in upside above 21. And that's why you would be buying the 21 strike call in this combination. So there you have it. Those are the basics. That's how you navigate the options grid. It's very simple. Just got to know, whenever you're bullish on a stock, you're selling a put, you're buying a call. That is basically it. When you're bearish on a stock, you're selling a call and you're buying a put. Kind of sounds counterintuitive, but if you work your way through it, you do it a single leg at a time, you won't get in trouble. I'll see you guys next time.